Well, I'm going to do a couple things in this video. One, I am going to break down how we look at investments and multiple levels and multiple strategies on how investors look at properties. Hey family, this is a real life scenario of the day-to-day things that I go through. And these are some of the things that with everything that's going on in the world, financially, you should know. A lot of people just look at flips or look at rentals and on the surface level. This is going to take a deeper dive into what high level investors look at, not just in what they're going to be getting back, let's say on a monthly revenue or a flip, but the tax consequences and or the tax benefits by using the system that is 100% legal and is there for you to use. Again, this is not financial advice. This is just educational. One more time, I'm not a financial advisor. This is not financial advice. This is for educational purposes only. We do have an executive team that can implement all of this for you and set up any kind of trust. We do have a CPA that can go over any of the tax implications and can break everything down for you. So if you need info, if we are your personal concierge, and we have the list of people that we can send you to. Now, let's jump into it. So I was speaking with a friend. Let's call him Mr. Smith. Now the Smith family, this is a situation. I'm going to give you the situation and then we're going to jump into it. They're partnering up with another investor. They have 2 properties and they ask, hey, what should I do with these properties? As you can see here, property number 1, if they sell it, they would list it and sell it for around $550. They owe about $200, so there's about $350,000 worth of equity. Home number 2, their investing partner, if they sell the house, it would be worth about $350. They owe about $100, so there's about $250,000 worth of equity. Now, just as a precursor, all of these are relatively round numbers. You're not going to get to the penny, to the dollar exactly, but you're going to get very, very close. Every situation is very different, and I'm going to do my best to break down as close as I can without overwhelming you. Now the situation here, when I spoke with them, they asked, what should I do? We're looking at selling both properties, paying everything off. And we look at things and we look at debt is bad. I understand. If you can't control debt, if you don't know how to use debt, it is a double-edged sword. It's a double-edged sword either way, even if you know how to use it. Now, what you need to understand is that the whole system is built on debt. You can't tax debt. Look at this picture right here. The United States makes, let's say, $4 or $5 trillion, right? They spend more than that. And look at this. Look at the bottom right. We think we're $35 trillion in a debt. Look at the bottom right of this calculator, guys. It shows our Medicare and our unsecured debts. That's hundreds of trillions of dollars. So essentially, we're so broke that there's no going back. We have to. There's a new financial system building. We are living literally through the new 1971, from where we went to gold standard to the fiat standard we're on now. Now we're going from the fiat standard to a digital standard, guys. It's just a reality. It is what it is. So you have to think of debt a different way. If you don't, you are going to be completely left behind. So that is the reason why I'm sharing this. That is the reason why I'm wanting you guys to understand this and so you can implement it, right? I'm giving you everything, guys. I'm giving you everything. It's taken me, I don't even know how many years, 10 plus years, hundreds and hundreds of thousands of dollars that I've spent in educational learning, and then also like learning on the streets and then just getting my teeth kicked in, right? So these are the things that I've learned that you can learn, or if you need, hey, come to us and we'll help you out. Anyways, so I said, hey, don't sell both your houses, right? Because they're looking at buying this investment property. This investment property, if you look here, it has 2 homes and it's on 5+ acres, right? So what I told them to do is this: take your first home, get a home equity line of credit. You can pull out, let's say, up to around 90%, give or take, depending on the lender. But I said, hey, be conservative. Let's do 80%, right? So getting a HELOC, about 80%, right? And that's 80% of your appraised value on your home. So 80% of $550,000 is $440. And if they owe $200, they could potentially get a HELOC for around $240,000, right? So they have access to that, right? I say this all the time. People say, hey, you're lucky or there's luck. No, luck is when preparation meets opportunity. If you're sitting on $240,000, a line of credit that you have access to right away, an investment property comes and you can just slap that down and then refinance it, boom, that's how you do it, right? They said that house number 2 with one of their investing partners, it's their primary residence. And I said, hey, if you do sell that, you get $250,000, right? So they had access to that. Obviously, there's fees, guys. There's realtor fees and blah, blah, blah. Let's just keep this round numbers right here just for, again, for educational purposes. So let's check this out. So this investment home, purchase price, $225,000, right? It has 2 houses, 5 acres. They got, a lot of awesome stuff on there. Roughly the aftermarket value, that's what ARV, if you see right there, that's what ARV stands for, is about $850,000. So what I told them to do is this: go to a private or hard money lender, right? They're going to give you roughly about 75% of that completely total, right? 70, 75. Again, this is rough depending on who you go to. There's tons out there, tons. What I want you to understand, it is not the money problem. You don't have a money problem. You have a deal problem. So if you have a deal and it is a good deal, you will find the money for it. So let's say all in, the lenders are going to give you about $75,000, right? If the property legitimately is $850,000, all in, they'll give you $637,500, right? Let's just round it up to $638,000, right? So right here with a $638,000, you're going to minus the purchase price. So you could potentially get the acquisition and rehab, right? So there's lenders that'll get you acquisition and rehab. You just got to put a down payment, and I'll explain that. But you got to put a down payment on your purchase price, PP, your acquisition, whatever you want to call it. And as long as it's under that threshold of that 75% all in this case, then you're all good. You'll get it might even be more than in this case, $113,000. It could be a lot more. All right. So the hard money lender, they're going to require you, let's say 20 or 30% down, depending on the kind of investor. If you're a brand new investor, you're likely 20% plus. If you're an investor who's done a lot of deals like us, it's less than 10%. So every hard money, every private lender is different. Talk to them, see what they're looking at doing. Anyways, let's go right in the middle, 25%. So if the purchase price is $225,000 for the investment property, right? 25% of that is $131,000. Right, so you're taking your 131 you get from that first house that you sold, you put it down on this property, some of that, right? And so your first loan right there is $394,000. And let's say they potentially give you another $113,000 for rehab. That is amazing, right? Did you know they do that? No, maybe you didn't. So again, just to just to bring it back home, house number 1, you have a home equity line of credit. You have access to $240,000. House number 2, you sold it. You have approximately $250,000 in cash, and you're looking at this investment property. So you're going to put down $131,000. Let's say rehab, you're going to be $225,000. Let's say you want to go baller status on this thing, baller status. That's a huge rehab. But let's just say it's $225 total. You got your contractor, you got your city permits and county permits, whatever, and you got all your whole budget. You do your thing, and it's $225,000. The hard money lender will potentially give you again $113,000. So out of pocket is going to be very, very minimal, right? You can see what that's on here. I'm going to break that down even more later. What I do want you to realize is this: there are points, right? People are afraid of the interest rate. Oh, they're going to charge me 10+%. Guys, you got to understand the world lives off of debt. So if you only have to give a little bit of your money out and then you can leverage and do other people's money, stuff never goes how you plan. So leverage carefully and make sure that the numbers work out. So let's look at the blue right here. Right, 507 all in. How do we get 507? Or these couple numbers up here, 394 plus 394 plus what you put down, 131, right? And so, or 113, and times that by 12%, right? So that's gonna, interest only payments are what private and hard money lenders do. They normally give you up to a year, roughly. So $60,840 a year is what you'd be paying, right? And let's say roughly $5,070 a month. Let's just lower that to $5,000. Let's just make it even, $5,000. So let's say this process takes you 8 months. 8 times 5K is $40,000 in interest. And you're like, Thomas, $40,000 in interest? Bro, you don't even understand. That's how much sometimes I pay a month in interest, as long as the numbers work, right? Yeah, that 507 is right here. That 507 is a 394 with your first loan and 113,000 for your second loan, right? So if we look at this, 507, right, is your first loan, which is your acquisition, your purchase price, minus the, in this case, 25%, and the money that they gave you for the rehab, 113,000. Plus, you are going to have $40,000 in interest payments, right? In this case, 8 months at 5,000 equals $40,000, plus 20K and points and junk fees, and in either oh shit factor or Murphy's Law at $30,000, roughly 10%. Plus, you are going to be paying $112,000 in rehab because you had that $225,000 rehab budget. They gave you 113. You put in an extra 112 out of that money that you had. So all in, out of pocket with everything, guys, is $709,000. So check this out. The ARV of the home, of your investment home, is $850,000. You are going to roughly refinance it with a lender, right? So 75% of $850,000 is $637,500. You refinance it into a conventional loan, your monthly payments are roughly going to be $6,600, right? And you're like, bro, that is way too much. Well, check this out. Your rent is going to be on one home $3,800 and the one on the other home $2,500. Right? You balled it out. It's going to be super nice. It'd probably be more, but who knows? Let's be conservative. Total, you're still short though. 6,300 doesn't add up to 6,600, right? So if you look on here, you're going to be negative $300 a month or negative $3,600 a year. Now, I don't know. You tell me, is that a good deal or not? You're negative. Check this out. This is where the average investor stops and the sophisticated investor looks in deeper, right? There's this. Again, let's go over this. Smith family of 4, making about $250,000 a year. They have 2 kids. They're going to be paying roughly, right, guys? I estimated this stuff, Fed and California state taxes, roughly $56,000 to $60,000. So about $4,000 to $5,000 a month in taxes, right? So with that, this is how the sophisticated investor looks at things. The CSA stands for Cost Segregation Analysis. So you're going to do a cost segregation analysis on your investment property, and you're going to use bonus depreciation, and you can hyper depreciate your property 20 to 30% a year-ish, minus the land cost. I know that's super confusing, so let's just call that $225,000. Yes, you can depreciate approximately, every case is different, $225,000 of your own W-2 income. Yes, that is right. So if you have $250,000 and you bonus and hyper depreciate this, you minus the $225,000, you are going to be paying on you're going to be paying taxes on $25,000 in total taxable income. And very easily you can get that down to zero. I think it's $27,000 Fed just for that standard deduction, right? So without even using the standard deduction, you're wiping off your Fed, you make a couple charitable contributions and you can wipe out your estate. Right? So does this make sense? Your tax savings is going to be using this strategy, your tax savings is going to be $56,000 a year. And you're going to minus the $3,600 a year that you used for rental loss. So you're still going to be positive over $50,000 a year, $52,000 plus.
What did he say?
A year. Now, this is why, everyone, who you choose as your real estate agent matters. Who you partner up with in business matters. Where you hang, if you're a real estate agent, where you hang your license. This is what matters because they do not teach this in school. And a lot of even high level people, they don't teach this kind of stuff because they don't go down to the details. We have the professionals, CPAs, accountants, bookkeepers, attorneys or business people to set up organizations and LLCs for you. So let us know. We are your personal concierge here. If you have any more questions, just give me a comment in the DMs. And you know what? Have a blessed day on purpose.